Hey, everybody. It's Michelle K here of doing my live stream, Go Live Long Beach. And I just know if I have my new hashtag. I like my new hashtag, Michelle K knows real estate. I just want people to know. I think a lot of you out there know me for my community activities. I do my yearly, twice a year shred events, and always think that the first Saturday in November at Cal State Long Beach will be the next one. And then also I do yard sales just to sort of meet people, get my name out there. But I just want everybody to remember that what I do is sell real estate. I've been selling real estate in Long Beach for 12 years, and I know what I'm doing. And I'm a good agent. Just ask my past clients. I've got lots of good customer satisfaction. Okay, enough about me. Sorry. All right. So I have as my guest today, it's Lance Ray, and he's a loan officer for Guaranteed Rate is a huge company. I on my listings, I've dealt with other lenders have been representing the buyers, and I have to say, very good company. And of course, we've had the interest rate increase. So I thought it was a good time to bring a lender in, and we'll bring them on in a moment. But just before we do that, I just want to quickly talk about the Long Beach housing market and what's going on there. We had our office meeting. Compass has an office meeting once a week, and the stats they gave us was in April there were slightly over 200 active listings in Long Beach, and then going to May, there are now currently a little over 300 active listings. So quite an increase. Yes, I think there's a lot of people who are like, oh, on the sidelines, I should take advantage and put the house on now. And I was a little bit concerned seeing all these things come on the market. So, oh my gosh, because I have a listing coming on, and am I going to have buyers? But I have to confidently say everything that came on is now, almost all of it, unless you're pricing it too high, is went into escrow. So believe me, there are still buyers out there. There are buyers who have sat on the sidelines, and they're ready, and they're also probably worried about the interest rates going up. So now's a good time. So if you're a buyer, I think it is a good time to look. And seller, I think it's all still looking very positive for everybody right now. All right. So if you have any questions, on Facebook for Lance, just pop them in. I've got my glasses on. Can see really well today. Any questions, I'll pop them over to him. So I'm gonna bring Lance in here. There you go.
Hey, how are you?
Hi.
Can you hear me okay?
I can hear you. Okay, we did good.
I think so. Hey, well, I appreciate you having me on today. It's flattering that you wanted me to come on and talk to your followers here. You already said a lot of the things that I was going to say, but just to reiterate, I work for Guaranteed Rate as a loan officer. I've been here for 12 and a half years now, which is an eternity to be with one lender. And, it's typical for our industry for people to change every time the wind blows the
Yeah.
wrong direction. So I've been here for 12 and a half years. We are a huge lender. I think we have 6 or 7,000 employees nationwide. Illinois based, the corporate's in Chicago. We were the first California branch when we joined 12 and a half years ago. So a little claim to fame there. I've been doing it for 18 and a half years total, ever since I graduated college. And man, that seems like a heck of a long time ago. And, the reasons why I stayed at Guaranteed Rate for as long as I have is we're extremely reliable. I can't remember one loan that didn't go through that we pre-qualified the client. We're extraordinarily reliable
You know,
and
let me ask you, yeah, just let me ask you a question. Do sometimes, you're a direct lender,
we are.
right? Okay.
Yes, we are.
So maybe people, I think this is confusing for some people. And then you have people who are lenders or loan officers, but they're brokers, correct? Where they
Yeah,
go
and you can
and
expand on that too.
okay. And so I've heard that a lot of brokers actually go to Guaranteed Rate to get the loan, correct?
We're not a wholesale lender. So what you're talking about is what's called retail versus wholesale. So wholesale would mean a lender that accepts third-party applications. TPO is the phrase we use. They
Okay.
take them from those independent brokers. Retail would mean the loan officers like myself work for the company, work for Guaranteed Rate, etc. Okay, Guaranteed Rate does not do wholesale at all.
Uh-huh.
So everything that we do is retail. And to expand a little bit about what the difference is, working for Guaranteed Rate, everybody that I work with also works for Guaranteed Rate. So the underwriters that are assigned to my files all work for Guaranteed Rate. Many I've worked with for years and years and years. So I have a huge advantage in the sense that I can ask my underwriters questions ahead of time on a file that might have a specific item that might go wrong necessarily, right? All the
Right.
funders and
Right.
closers, the people that draw the docs, worked for years and years and years, and I've been fortunate enough to have an amazing career thus far, and I get to pick the best people that I feel like would work the best for me, right? And
So
so
I think any lender that I've ever used, I like that whole, I'm gonna say in-house, right? Like,
everything's in house, yeah.
right, like I always say, like, okay, this person, you know, has a relationship with that underwriter, or at least you're all, like you said, you're all working for the same people. I had gotten an offer and we accepted it from a buyer, and it took so long to close, and my bad. I thought the company that the lender was with was a direct lender. I assumed, and they say
Right.
never to do that. And it was probably maybe about 2 years ago, right when all those refis, right? So many refis going on. And what happened was they got pushed to the back of okay, you guys don't do that, but they probably went to, sorry, competitors, Rocket Mortgage or somebody like that, and it took them forever. Where this is what like I said when I started, I've dealt with other lenders from Guaranteed Rate because they came with the buyer, and I tell you are on your game.
Yeah, I mean, you said what a broker is exactly right, which is the reason why I decided not to be a broker in broker loans is because you essentially have no pull. You're an intermediary, kind of like an insurance broker is a great example. An insurance broker is just trying to shop you to a bunch of different places, but has no say on anything. Obviously, there's much more intricacies with a home loan versus insurance, but I mean, I don't know who the underwriter is going to be. Heck, I could choose one of 10 different lenders potentially. So I mean, you want to talk about everything being random from the appraisal process to underwriters to whoever. It's a much different process that you feel you're out of touch, you're out of loop. You can't call your loan officer and find out exactly where the loan is because they probably don't know. They'd have to call the lender that's actually funding the loan and try and get some details about where it's in the process. So that's exactly
Right,
right.
right. So I think that's a really important thing to tell buyers, know
No doubt.
what type of lender you're working with.
Highly
Yeah.
advise a direct lender, in my opinion, which again, why I decided to be a direct lender and stay there because there are, perks of being a broker, just in terms of how you paid, maybe on a 1099 versus
Yeah, yeah.
W2.
You're
Yeah, we
you're not
probably all
working.
need benefits there. As a direct lender, I'm paid strictly on a W2. So despite the potentially less advantageous from the perspectives that we all hope things are a little bit more advantageous, I've chosen to stick with the W2 because I think we do loans so good where I am.
Yeah.
Um,
Yeah, and I'm going to ask another question that I think if I was a buyer, and I do work with buyers, and it comes up, they're going to say they're going to talk to different lenders, right? And we're
right.
going to we're going to shop the loan. So it's like, oh, well, their rate is better. So in my mind, I'm always like, wow, like that rate changes so frequently,
It does.
right? I mean, what you guys look at on the back end to determine what the rate is, I think the question should be when you're shopping it is, what are your fees, right?
Right.
So put yourself in the buyer's position.
For sure.
What questions would you ask a lender?
Well, I mean, I'll explain it to you as if you're a client of mine and why I think our
Perfect.
rates are good and why, I've been fortunate enough to work with so many realtors such as yourself for years and years and years. Is because of how we set up our pricing. Now, every lender is going to have some basic processing fee to pay their fixed salaried employees, whether or not it's $1,500, $1,900, $1,200. Ours is $1,440. So everybody's going to have those fees. The key component
Sweet.
that is variable is the compensation that the lender makes in comparison to the interest rate. So I think the key question here is, why are some lenders on the same day? Because rates do change every day. So if you're going to compare with lenders, you want to try to do it the exact same time,
Same
same day.
day.
Okay.
Okay.
Why
Right.
does one
Okay.
lender have a better rate than the other on the same day, considering the same market conditions? And the answer
Right.
is that profit margins, right? Some lenders have different profit margins, and even further, loan officers can choose their own profit margins. The best example I can give you is, let's say you're a realtor and you want to make, I don't know, 2% on every listing or 3% on every listing. That's fine, but then you can't change it for any client ever. It has to be the same. If your relative wants to call you and say, hey, Michelle, will you list my house? You have to list it for the same that you're giving somebody else. Otherwise, we're considered discriminatory. That's the key phrase that the feds made when they
So,
put our rules in place. So the key here
okay.
is that my profit margins specifically are, to me, as low as they can possibly be. And the reason I've done that is because I don't want, realtors to refer me 50 clients a year, let's just say hypothetically, and half of them go back and say, we really like Lance, but his rates stink. I don't ever want that. And I never get that. And that's intentional, that we're not really battling for business in that regard. We always have a very competitive rate, so that we're just simply processing loans versus having to do some massive marketing campaign of how to get new things. People, hear, hey, these guys are competitive and they do a good job, so why not go with them? And so that's somewhat been my strategy my entire career.
Okay. Well, that's a great takeaway. If you're going to compare, make sure you're comparing apples and apples, that
For
you're
sure,
on the
same
same
day.
day.
Right. And now
Perfect.
obviously that gets us
Perfect.
to the key point that you wanted me to bring up, which was, how are interest rates going up impacting the market versus potentially not impacting the market? And I think that's a very, very important question, and somewhat tough to answer in the sense that everybody has a different spin. And again, I'm fortunate to work with an amazing a large group of agents all the time, and everybody has a different take on what's going to happen next, what's the impact going to be, etc.
Let me ask you, because everybody's today. What is your today rate?
Well, right, and
Your
that's why I want to go into a couple of things here. So,
okay. Go
first
ahead.
of
I'll
all,
let you
about
talk.
the Fed increase 2 days ago. Everybody, I mean, it's front page news. It seems like everywhere. The Fed raises the rates. They raised it 0.75% and talked about. Usually, it's what they talk about is going to happen next that has the most impact. They talked about another 3/4 being in play in July. Okay. So everybody probably thinks, well, wait, did mortgage rates go up 0.75%? Well, they didn't. If I use, now there's many different types of loans, so I'm going to use a most basic example to make a correlation here. So on the day that the feds were going to be leading up to the day, let's say Wednesday morning, a perfect 20% down loan amount at say 600,000, you would have been around 5,875 on a basic 30-year fixed. Okay.
Okay.
That's actually gone down since the Fed announced, for whatever reason. And when I say for whatever reason, there is no clear way. You're talking huge money, billions of dollars of bonds and things that are just beyond me. Okay.
Right.
But rates have actually come down about 1/8%. And if you follow the markets like many of you do, interest rates almost exclusively follow the 10-year treasury yield, which has gone down significantly since the announcement, which seems strange because they raised the rates and they're talking about raising them more. Why would they go down? In fact, let me just see where it is now. It's down to 3.2. It was at 3.5 a couple of days ago. So that key barometer is going down. So for the first part of what I was going to say is that what's happened with rates since the announcement, they've actually gone down. Okay. Now looking at a more to macro level versus where we were in, let's say, December 2021 versus now. In December 2021, you were still in the COVID rate era of 2.875, 2.99, again, depending on what day you caught it, since there are changes every day. I just said 5.875, right? So you've got this 3% roughly delta. There are some days where rates even 10 days ago were down to 5.5, right? So it's kind of going back and forth between that situation. So what has changed in the market, I think, is the big question here. Okay. During the COVID, and this is just my hearsay from realtors that I talked to, if you had a listing, you would have 25 offers within a week. Okay.
Right.
Despite prices going up even a little bit, the fact that you could borrow cheap money was pushing the market and making it as competitive as it was. Now that rates are higher, it doesn't mean that nobody's buying houses. There's still a tremendous amount of activity. And now instead of getting 25 offers in a week, agents are getting 2, 3, 4 offers, which might actually still be higher than what the activity level would have been pre-COVID. So people are still buying houses. It's just their mortgage payments are higher. So if you're a buyer and you were sick of the competition that you were seeing last year and the year before, that competition is starting to dry up as people, of course, don't want to necessarily pay that higher payment. It's a little easier to get in there. And so what's next for the
Right,
market?
right.
There's three basic philosophies. And did you want to add something there, Michelle?
Yeah, I just think, I think, our take on our industries are the same. It's like, okay, whereas the last 2 years were so abnormal, right? That and so is this is the normal, which really isn't the normal, because if you go back to historical, we're still selling
More
lots of
activity.
houses, and there are lots of activity. So anyway, I just
Totally.
wanted to.
Yeah, totally. And so a couple of things that I think I would hit on, and then what different philosophies I have heard and what I think might happen. So first
Okay.
and foremost, values, obviously went up significantly the last 2 years, three, heck, really ever since 2010 at some rate, whether or not it was, gradual
20.
or some years, right, or some years that were more significant, like say last year. I think one good thing is that prices are probably not going to increase other than maybe a normal rate, assuming that they do increase moving forward. So rates have somewhat stopped that, which I think was healthy because, I mean, what if we had another 20% increase this year? I mean, that then we would get into a strange territory of
Right,
unaffordability there. Okay.
right,
What
right,
happens next is the key. There's some people that think that the prices might go down, but maybe not that much. There's some people that I've talked to that think that there's such a shortage in housing, and rents are obviously pretty high in California as well, right? That prices might still ease up, maybe not quite at the same rate, but they might ease up. And the big example that they use and why there's a shortage are times like this. So for those of you that were uh, around and maybe thinking about what happened in '08 and the crash, home builders stopped building houses for several years during that time. That
mhm,
time when home builders stop building houses creates a housing shortage, okay? Because they should be building houses at a certain rate to keep up with population growth, okay? The same thing is about to happen now. There's builders that have all this land ready to go and cleared, and they are slowing down their production. So we have all these people. We're still increasing in populations. Well, in most areas, I guess they say California for the first time is going down, but in some areas, but we're not building houses necessarily to keep up with it. So one thing that will continue to push demand is people need places to live. No matter what the situation is, people need places to live. And so that's
right,
one of the theories is that doesn't matter where interest rates go, people will continue to buy. They'll continue to buy at these prices, and we won't see any type of significant decline. And of course, is that segment of people that think the prices will go down significantly. But I think that is not necessarily specific to the housing market itself. I think it's more tied to the overall economy. I mean, we've all seen our 401ks or stock portfolios, or if you're a crypto person,
right,
whatnot. Everybody's values and asset values have gone down, with the exception of real estate, strangely enough, right? And so
right,
obviously,
right,
if we have some huge drop in those other asset vehicles, a lot of times that's the money that people had sitting in the stock market or sitting in their 401ks to
right,
draw against for down payments. So those types of overall macroeconomic reasons could impact prices as a side alternative as a result of the other
right,
factors. So that's one thing that I don't think is predictable, because there's a lot of different theories again on why the economy is going down some, or why the asset prices. Who knows what the overall economy is actually doing? But the things that we have barometers of, such as the Dow, the Nasdaq, crypto, whatever you want to follow. Um,
right,
those there's different things that are in play. So
right.
those are the three theories that most people hear. What do I think is going to happen, assuming we don't have a major economic event? I think prices will hold, maybe go down subtly. But I think once we get inflation under control, I think we might even see interest rates go down. Some people think rates are going to be at 8% mortgage wise. We're talking about here later this
Right,
year. I would
right,
just stunned if I see that happen. I don't think it will
right.
be that high. I think once we start getting into points where inflation's lower, then the
Uh,
market will definitely interest rate market will stabilize and
well,
maybe even go down.
yeah. Well, I like your theory. Or your prediction. I hope that's true. From what I'm seeing, just new buyers on my listing. people who have just saved, they just have, maybe about 10% down, but, they can pay that monthly mortgage. And, what I've always said to buyers, and especially when you're working with young buyers, it's like, look, can you pay that monthly payment? If you can pay that monthly payment, there's going to be ups and downs in this market, right?
Right.
Just like there are in the stock market. Right. But there's that emotional, then you need somewhere to live,
Yeah,
and people need somewhere to live. They want to have children, they want to move by their children. So, yeah, I think that, I think we're fine. I think
I
everything,
think we're going to be
just,
fine as well. I mean, again, macroeconomics. Obviously, there's some stuff going on in Europe that's impacting things. But once the things like oil prices and whatnot stabilize, I think that'll stabilize everything, right? And we'll
yeah,
get back to some sort of thing. It's just that unknown, which I believe is pushing rates up and inflation up, and trying to counteract that. So once some of those things stabilize, which hopefully will be sooner than later, we won't have
yeah,
quite as many questions. It'll just be business as usual without the and it is now. I mean, there's still plenty of people doing well. I told you when I came
yeah,
on, I already have 15 purchase loans funded this month so far. And so there's plenty of people buying, plenty of people selling. So the market really, if you look at the overall number of sales, hasn't changed despite rates going up. So
no,
there's not any
yeah,
difference. It's just maybe a smaller pool of people. Maybe there's a few people that just can't afford the payment at the higher rates, and so they're out of the market. So instead of there being 3 times as many buyers as maybe there would have otherwise been the last 2 years, maybe we're a time and a half of what it typically would have been,
yeah.
3-4 years ago. So there's still tons of activity, tons of people that want to buy, and I don't expect that to change.
Yeah, no, it's good. I just want to give a shout out before we wrap this out. Lance, you send out a text message, not every week, huh? You say when you have a difference in the rates, and just brilliant. Just because you get this text message and it just gives you Fannie Mae, conventional, FHA, and it's just because we can't keep on track of everything, right?
Yeah,
We're real
and I
estate
do try
agents.
to send
We're
it out
all
once a week, by the way.
yeah, you're good. Yeah, no, you're good. And all right, I'm trying to think if there's anything else we really wanted to touch upon. I think
I mean, the only other thing that maybe there's that people say is, oh, well, the interest rates in 1975 were X and Y, and so I wrote down a couple of things. They were 10% in 1990, they were 8% in 2020,
were they
6%
10% in 1990? 10%, huh?
10%, yeah, and then they were 5 to 6% in 2005. 2010, they were about at 4 or 5%, which is lower than where they are now, right? And so
Yeah,
that's an interesting
yeah,
one there because that's was a downturn in the economy as well. So that one's an interesting one. And of course, they were 3 to 4% in 2015, and 2015 wasn't so bad, right? I mean, we were in pretty good shape and accelerating. So now we're talking about just under 6. And you look at all of those things as could it go back to 10%? I don't see how that would ever happen again without a catastrophe in the market. And people were like, well, why not? I mean, how can you compare 1990? We didn't even barely have computers. I don't remember. I was, I guess everybody would know my age. I was 10 years old at the time, right? But I mean, I don't remember us having some high tech technology, and now everything is available at our fingertips. That I don't see how we could go back to those things. I mean, you had to put down 10, 20% mandatory then, and we're not going to go back to that ever, And so I
yeah,
think interest
yeah.
rates have to be a certain level. What would be your quote unquote safe or average spot where maybe we will average over the next 10, 20 years? Maybe it's 5%, maybe it's 4.5%. I don't know. But I don't think we're ever going to those higher rates. I think that personally now, I think they're higher than what they will be historically. And many of the buyers that I have are like, man, we're getting in, my payment's $500 more than what we were hoping to be. And I was like, look, once rates go down in a year, 2 year, 3 years, whatever the case may be, we'll just refinance you down. It will be short lived. There's no way that it won't happen at some point because history tells us the rates will go down at some point, even if it's not even for some significant reason like COVID or whatever the case may be.
All right. Okay. All right. It's interesting. That was interesting. Good historical information. All right. Well, I've never seen Lance's face before. I've talked to you for years, so this is
Right.
always this is
That's the
always like, oh,
interesting thing
okay.
about it. I mean, and not to get off on a tangent. I mean, I've had people that I've worked with for 10 to 15 years, and I've never met them in person one time. We just always talk on the phone and text. And it's the strangest thing, isn't it?
It's a stranger thing. See, this is the new world of Zoom. It's yeah, it's all good. All right, you go have a good busy day. Have a even better weekend. Enjoy all your little girls, your three girls.
I do
It's
got three
nice.
girls. That's right. You got it. Four,
Yeah.
five, and seven. They're a handful for sure. Super. So,
That's why you
well, I
look so
appreciate you
fit.
having me, and we'll talk soon.
All right, take care.
You take care.
Bye now.